Not everyone is bullish right now, including Barclays Investment Solutions, cutting developed market equities in its tactical portfolio for the first time since 2012. Barclays Smart Investor CIO William Hobbs writing the following: our assessment of the various risks and opportunities over the next 3 to 6 months in the US and indeed wider developed market stocks is now a little less glass half full than that seemingly implied by markets. William Hobbs joins us right now from London. So William, walk me through the thinking here. What aren't we getting right?
Yeah, thanks for having me on the show, John. I think one of the things that we've looked at for the markets for the last couple of months, if you look in December, it's been like being on a plane, going through a little bit of turbulence, but with an insanely hormonal 2-year-old in the cockpit. You had the deep despair of December, and then we had, which was the worst December for US stocks since the 1930s, and then January was the best January for the MSCI All Countries World ever. So in a way, this is all sentiment because the outlook for the world economy hasn't changed that much over that period. It's deteriorated a little bit. Europe's a little bit worse. Some of that fiscal juice has ebbed in the US, and China's slowed a little bit more than expected. But markets are now in that kind of manically happy phase, and I don't think, or we don't think, that necessarily reflects the incoming reality. Profits growth is going to be pretty meek. You guys just talked about peaking profit margins. That's one of the stories out there.
So, Will, the question and the response back to that by a lot of bulls would be peak margins don't have to mean peak markets. What do you say to that?
Yeah, that's right. But I think if you look at what markets have done so far this year, and you don't just want to look at year-to-date figures, you're already up 12% in US and North American equities. Now, what are you going to get for profits growth this year in the US? What are you going to get in developed markets? I can't think that you're going to get much more than mid-single digits. You're pretty close to zero in Europe, to be honest. Now, do we think we're going to get big multiple expansion this year? Again, that may not be the case. Now, I've got to be clear here. We're not packing our investment bags for the kind of dark descent into a recession. We still see the risks of recession in the next 12 months as low. But in a sense, this is a period of the cycle. You're entering a late phase of the economic cycle. That tends to be a period when you want to run a lower baseline of equities and be a bit more agile around the edges and trade sentiment a little bit more. And when sentiment is at the extremes, our sentiment indicator being at this extreme has been consistent with negative returns in the ensuing 2 months from US stocks. That's really what we're playing here. Just to give you an idea that we're not too negative on the cycle, we're still underweight duration. We still think the bond market's too pessimistic on the outlook for growth and interest
So, William,
rates.
I hear you. It's pretty clear. You aren't that bearish. To be honest with you, it sounds perfectly clear to me. The story I want to get to you, if you're going to reduce equity exposure, is there a regional bias you're still leaning into, so to speak? Is it into EM away from DM? What is it, William?
Yeah, so good question, John. I mean, one of the things here with this sentiment indicator I'm talking about, the explanatory power is mainly to do with US equities. So we're using US equities as a kind of proxy for developed market equities. We're still actually a little bit positive on EM. We've got a 2% overweight there. We still think actually sentiment is a little bit less overcooked there. We still think that you'll see China do a little bit better. Some of the problems in China we think are outside of the trade sphere. They're more to do with self-inflicted wounds. The authorities there have been deliberately trying to slow the economy, deliberately trying to play whack-a-mole with kind of those financial stability risks. They're now tapping the accelerator again, and that'll come through in the second quarter, in our opinion. That should be good for EM.
So, William, final question to you, and it's been a theme for this conversation over the last hour or so, in fact, for the last few weeks. You seem to share that faith in the Chinese policymakers' ability to stabilise the economy. Why do you have that confidence?
Well, it's a controversial fact, isn't it, John, that their policymakers, increasingly controversially, still sit at the commanding heights of the economy. They still operate the major levers. Now, one of the problems they've had with transmitting policy in some way has been to do with the fact that local government officials are now a little bit more confused about what they're supposed to do. So they're now beholden to the property, the projects they approve in perpetuity. So that's meant a little bit more reluctance on their part to spend some of that loosening. But you are seeing it come through now. So our bet is that they still retain enough control of the economy, and they still have the will to do so, to sort of beef the economy up a little bit.